start the week off, we're looking at Germany and whether they are facing a deflationary crisis, what that might mean for certain asset prices. And then we're moving over to the dollar. Where's it off to next? What could influence the price path of the American dollar? And then for today's Trading Takeout, we're going to be focusing on a successful way that you can maybe look at trading sentiment. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. In front of you, we've got the producer price index of Germany and the CPI of Germany, so the consumer price index. So the producer price index is in green and the CPI is in orange. Now, what you'll notice is that the CPI tends to follow the consumer price index. There's a slight lag. So you can look over time that it tends to change at a very, very slight lag, especially when prices are exceptionally elevated. And one thing that you might notice is this is the steepest decline in producer price index ever. I'm therefore concerned that this will also be the steepest decline in CPI, which is the measure that the ECB tends to look at to make policy. With Germany being the largest economy in the Eurozone, they tend to look at Germany quite closely. But this is where the problem of the Eurozone existing comes into things, because they have to set policy for the entire bloc. So then they look at something called harmonized consumer price index, or HICI or something like that. Harmonized index of consumer prices. I can't even think this morning, it's Monday. And this is where they get into trouble, because by setting unified monetary policy for this many countries, it means that there's inflexibility for each individual country to make their own decisions. Right now, for example, it would probably be likely that Germany would need a much lower interest rate than is currently on offer from the ECB, purely because the deflationary force here is so strong. Now, of course, there's base effects that we have to take into account. We saw a massive, massive spike up in producer price index previously, up past 30%, which is insane. Now we're seeing that big, big decline. And that spike in producer price index was mainly because of the gas situation from Russia. So German industry was running on exceptionally cheap Russian gas. Gerhard Schroeder was on the board of Gazprom. That relationship now no longer exists naturally, since the Nord Stream project is likely to be completely scrapped. And German industry is now completely in bits, quite frankly, purely because of this energy crisis. Now, what does this mean necessarily for the euro? I mean, if we were to perhaps overlay, let me just overlay the euro. So you can see here that it doesn't necessarily show that much of a relationship currently. However, what you can see is that the market does tend to price in on the CPI metric. If we just mute this one, how do I do it to hide? I can't hide that one just now, but if we focus on the orange label, you'll notice that here, for example, when we had a really, really steep increase in CPI, the euro rallied. I guess, where's another case here? Back in, well, this was more the German Deutschmark, I think, back then, but we saw it occur here. And, if you take that as a proxy of interest rates increasing or decreasing, the likelihood of the ECB's interest rate now decreasing is much, much higher, because inflation is coming down quite rapidly, specifically for Germany. So that gives kind of the view that the euro should, from a macro perspective, start ticking down too. There has been a big, big squeeze on the euro recently, though. I've actually got caught out on it. I was selling the euro, and I've got caught out between 1.07 and 1 spot where it is now, to be fair. So I've lost some cash on it, but I think over the longer term, that is the direction that the euro is going in. It's going lower, and that's the way to look at the market. But yeah, the deflationary force in Germany is very, very strong at the moment, and I don't really see anything letting up. Here is the dollar index right in front of you. And I'm wondering if the obvious could be this obvious. Okay, so in red, I've got a huge support line, okay, which stretches back to 1989, which is insane. And you can see it here. You know, there's a big old broken. There's a big old support here where we've broken through and tested it again. It's come off there as well. There, you know, you can see where the market hangs up and just trades around this at key points. Here it comes back and tests here again. So what I'm wondering is if now we get a situation very, very similar to I guess it's actually a different situation. It's a very different situation to previously. You know, are we going to get a situation whereby we now just start rallying up here? These are all untested. Remember, the dollar index is a function mainly of the euro. And so previously I've just spoken about euro weakness. Is it now that we start to really see the euro get considerably weaker because it has to, in which case we then start seeing, you know, a broader drop off in the euro over the next couple of years and the dollar really just makes way? These are the questions that we have to start asking because things have changed now since the inception of the euro. Germany, for example, was the stalwart nation in the Eurozone. You know, the euro benefited Germany heavily from a trading perspective. You know, there's basically two different euros when you compare Italy versus Germany. And so what this means is that now that Germany doesn't have necessarily the same industrial power, you know, lots of things being sent out to China, for example, to make and then bring back to the bloc, it could perhaps be the situation whereby the euro gets so weak that it's not necessarily even a function of the dollar getting stronger. It's just that the euro really, really starts to depreciate. Now, from this perspective, you have to start thinking, okay, well, what does that mean for the dollar index? And personally, I think, you know, we see a much broader move. You can already see a sort of cup and handle pattern that has lasted 20 odd years start to form. Is this something that we start to see? And we start to see a break back up there. Now, that would be very, very scary, quite frankly. I think that would mean that the euro actually finishes. But these are the kind of things that you can start mapping out in your head, even over this long period. Because now that you can see that there is a key level here, perhaps. Now, this isn't a trading level. This is just something to bear in mind for pivots and how you look at dollar pairs generally. Because the dollar index, you know, you can trade the future of it, but you may as well trade euro because euro is counter to the dollar. But these are situations that you start mapping out in your head. Now, over the shorter term, obviously, rate hikes are starting to get priced out of the market. Rate cuts are starting to come into the market, especially for the second half of 2024. It's expected that there's going to be 3 cuts now. So these are things to start really, really focusing on. Do we, and more specifically, actually, the pace of how interest rate pricing is changing relative to each economy. So, for example, just because the US is cutting doesn't mean that the dollar gets weaker versus the euro, because the ECB might be cutting at a bigger or faster pace. Does that make sense? So these are the things to start weighing up, especially when you're looking at slightly longer plays and longer durations on how risk might behave. So for me, the dollar meanders for a little while, but then we do see a broader dollar rally that will be quite scary in my view. So you really have to try and make the information that you consume easy on yourself. And it doesn't always mean receiving information from quality sources that are going to educate you. A lot of the information that I want to take in is from really poor sources, but people explaining why they're coming to a certain decision. Excuse me. So, for example, on the recent things that have been occurring over the weekend with regards to AI, I take the view that there's a lot of really, really overly clever people who are trying to force a niche for themselves, who then will put bets on that are bad bets because they're overly emotional, because of whichever industry or, whatever their agenda is. And they're speaking from emotion rather than from the reality. My view on AI is that it's a great tool for humans, but it's not going to ever replace humans. It simply cannot do that in the same way, because humans require, or the human condition requires, context. So when you're looking at sentiment from a trading perspective, you want to find the people that are speaking from their feelings, because generally feelings don't match up with reality. Unfortunately, it's a way that human psychology works. And so you are able to deduce a trade from this. If sentiment is overly exuberant about something, but the logic behind the content is not matching the feelings of a certain group of people, and especially if these people get exuberant over a lot of different things, or pessimistic, then you're able to actually go against them. And this is a perfect way to look at sentiment trading. There's a lot more to it, such as current positioning in a market as well. Just because people are overly exuberant, if the market isn't stretched to the upside, it doesn't mean it's going to come down. Vice versa with pessimism. If people are overly pessimistic, but the market isn't stretched, it could still go down. So you have to match up the actual market reality with the stretched emotions of a certain group of people.